Hello, good morning. I'm Avnish Jain. Welcome to the monthly outlook on debt markets from Canara Robeco. As usual, let's touch upon the global macroeconomic landscape. The barrage of tariffs unleashed by the US administration in last 3-4 months has kept market on tenterhooks. Recently, a US international court has ruled against the Trump administration on tariffs. But this thing is likely to go a bit longer and it's likely to end up in the Supreme Court of the US. Only then we will know the final outcomes on tariffs. In between, markets continue to gyrate between lows and highs. And if we look at US market, debt market, it was further affected by the passage of a big expenditure bill, which has been dubbed by the US president as the Big Beautiful Bill. This bill includes lot of tax cuts and expenditures which could lead to excess expenditure of almost $3.8 trillion over the next decade. This would raise US debt to GDP beyond 100% and severely impact the fiscal deficit of the country. Global markets are already getting worried on US debt, and we have seen US yields on the higher side. For the first time in number of years, the US 30-year yield crossed 5% and raised alarm bells across the world. In last couple of days, the yields have come down a bit and below 5% on the 30-year and around 4.4% on the US 10-year. These things will continue to play out till the tariff situation is settled, probably in the US Supreme Court. Also, the Big Beautiful Bill, which has been given by President Trump, has passed the House of Representatives, but is still to pass through the US Senate. That may take a couple of months more. In between, markets will remain volatile and we'll wait and see what happens next. In terms of oil markets, things are a little better. The OPEC plus countries have decided to raise output, which has led to fall in oil prices. Brent crude prices are now somewhere between $60 to $65 a barrel, down from about $70 to $75 a barrel a couple of months back. This is good news for emerging markets, especially India, which is a large importer of oil. Coming to India, Indian markets, especially the debt markets, have kind of disconnected from the US markets in terms of the yield movement. If we look at the 10-year, India yield is now around 6.20 and US yield continues to remain on the higher side. The Indian macroeconomic conditions continue to remain in a sweet spot. If we look at growth, last year was projected at 6.5%. The final GDP number is coming and we will get a final picture on the full year GDP for FY 2025. For FY 26, again the GDP is projected around 6.5 to 6.8 percentage points. This is a good growth and India is likely to be the fastest growing economy in the world in FY 2026. Inflation, which was a bit of concern last year, is now kind of coming down very fast. The last inflation print was 3.2%, which was well below RBI medium-term target of 4%. The RBI Monetary Policy Committee has already cut rates by 50 basis points, 25 basis in February of 25 and 25 basis in April of 25. The RBI governor in the last policy also dramatically changed the liquidity situation where they promised that they will keep liquidity surplus at about 1% of NDTL. Since February, RBI has been taking a lot of steps to increase liquidity in the system, specifically through open market purchases of government bonds. The total open market purchases now exceed almost 4 lakh crores since February of 2025. This has turned liquidity in the system into a positive surplus, and as RBI has also talked about that, they are likely to keep it in surplus in the coming months. This is to ensure that the rate cut cycle gets passed to the final borrower. For transmission of rate cuts, it was necessary for liquidity to remain surplus, and RBI is working towards maintaining liquidity on the positive side. With the macroeconomic picture being positive both from growth and inflation front, the external sector is also looking promising. With oil prices coming down, the current account deficit should also come lower. So overall, the macroeconomic landscape of India in terms of financial stability and in terms of growth and inflation trade-off looks good. The RBI Monetary Policy Committee meets again in first week of June, and markets expect that there will be another 25 basis rate cut in that policy. Further, there are expectations that RBI may do another rate cut in August as well. Overall, market is pretty gung-ho on rate cuts right now, and further rate cuts of 25 to 50 basis are penciled in for the rest of the year. Obviously, it will depend on the inflation and growth trajectory in the coming months. Monsoons have hit much before time, and that is again a positive, especially on control of food prices, which have been responsible in a big way for inflation spike last year. China's slowdown has been a boon for Indian markets, especially on the prices side. With growth slowdown, China exports products to a lot of countries and makes prices come down faster in other countries and keeps prices lower. That has happened in last couple of years, where India's core inflation has been on the lower side, and the volatility inflation is seen mostly on the food prices. We expect inflation to remain contained with around 4% range, which is the medium-term target of RBI, and we expect market yields to continue to fall in the coming months. A 10-year could breach 6% in an event RBI cuts 50 basis in the next two policies. Overall, we remain constructive on the market, and in this scenario, investors can choose to increase allocation to debt products depending on their risk-return profile and their investment horizons. For a shorter term horizon, investors can choose to invest in money market funds like savings fund and ultra short-term fund. For medium to long duration, investors can look at corporate bond fund, gilt fund and dynamic fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.